Okay, let's unpack this. Have you ever wondered about the unique ways financial transactions are structured within Islamic finance?
Hmm.
It's a world built on principles that might just surprise you, especially when it comes to something as common as buying a home or a car.
Right.
Today, we're taking a deep dive into Murabahah, a fascinating concept that truly forms the backbone of many ethical financial dealings.
It really does.
Our mission is to extract the most important nuggets of knowledge from our source, Almiyar al-Shari number 8, almirabaha.pdf. We want to help you grasp the critical rules and nuances of this Islamic financing method and maybe, have a few aha moments along the way.
And what's truly fascinating here, I think, is how Murabahah is meticulously designed to avoid interest-based transactions.
Yeah.
It focuses instead on tangible asset sales with a clear, agreed-upon profit margin. So this deep dive will illuminate the strict yet kind of elegant guidelines that make Murabahah compliant and ethically sound.
Like a shortcut to understanding it.
Exactly. Think of it as a shortcut to understanding a financial tool that's both complex and incredibly principled. We'll explore everything from, how a client first expresses interest right through to the nuances of debt management.
Connecting the dots.
Connecting the dots to the bigger picture of Sharia-compliant finance. All right, so let's start at the very beginning then. Let's imagine someone, let's call it Alex, wants to buy a new car using Murabahah. Where does that journey kick off?
Okay. It all begins with what's called the client's desire, or Rabat al-Amil.
Rabat al-Amil.
Yeah. This is simply Alex expressing to the financial institution, let's say it's a bank, that he wants to acquire a specific commodity, like that car.
Okay, so Alex walks in and says, I want that particular red sedan I saw down at Speedy Motors. Is he allowed to be that specific with the bank?
Oh, absolutely. The source confirms that Alex can specify a particular seller, Speedy Motors in this case, for the desired commodity, provided, of course, it aligns with Sharia guidelines for the sale itself.
Now, here's a subtle but important point. The institution, the bank, has the right to decline if Alex rejects other offers that might be, more suitable for the institution.
More suitable, like cheaper.
Yeah, maybe a better price from a different dealer, perhaps better terms. The bank needs to ensure Alex receives multiple indicative offers for the car. But it's key to remember, these prices are just that, indicative. They're not binding yet.
Gotcha. Indicative. And what about the actual contract? Does it happen automatically once the bank says, okay, we found the car?
Well, not quite automatically in the sense that no explicit agreement is needed later, but the process of concluding the Murabahah contract can be initiated once the institution's acceptance issued within a specified period. And that's based on Alex's initial request.
Yeah.
Generally, though, his initial request doesn't include a promise to purchase.
Oh, okay.
Unless he explicitly states it, puts it in writing.
That's interesting. So Alex isn't immediately locked in just by asking. He has some wiggle room.
Exactly. It gives him flexibility. And for practical purposes, it is permissible to combine Alex's initial request and any promise he might make into a single document.
Makes sense.
Yeah, it could be a standard form from the institution or even just a written document from Alex himself. It just helps streamline the initial paperwork.
Okay, so we have Alex's initial request. But before the actual Murabahah contract gets signed, what kind of groundwork does the institution need to lay to make sure everything is, strictly compliant?
Right, and that's where the integrity of Murabahah truly shines. The procedures before the contract is formally signed are absolutely paramount.
Why is that?
Because they prevent the transaction from just mimicking an interest-based loan. It needs to be a genuine sale.
Right.
This means, crucially, any prior connection between Alex and, say, the car dealership must be genuinely canceled if the bank is going to step in. The original seller, Speedy Motors, in our example, must be a third party.
A completely separate entity.
Completely separate. Alex cannot be the seller or their agent. And even the dealership, Speedy Motors, can't be more than half owned by Alex.
Ah, that prevents conflicts of interest.
Precisely. It's all about preventing fictitious sales, ensuring the bank is truly buying from an independent source before selling it to Alex.
That makes a lot of sense. It's like the bank can't just be a rubber stamp for a deal Alex already cooked up.
Exactly.
Are there any other, hidden traps or prohibited structures the source warns about in this pre-contract phase?
Yes, definitely. There are some strict prohibitions. For instance, the institution cannot agree with Alex to jointly participate in a project, maybe buying a property together, with a promise for one partner to buy the other's share via Murabahah later on.
Why not?
because that structure can easily open the door to interest-like scenarios, which is exactly what Murabahah avoids. However, there's a permissible alternative. If one partner simply promises to buy the other share at market value, or some agreed-upon value at the time of the future sale, that is allowed. But it has to be through a completely separate purchase contract later on.
Ah, the separation is key again.
It's a subtle but very important distinction, yeah.
So it sounds like Murabahah is really focused on tangible assets. Are there any assets that are completely off limits for a deferred Murabahah where payment is later?
You've hit on a critical point there, yes. Deferred Murabahah is not permissible for gold, silver, or currencies.
Why those specifically?
Well, in Islamic finance, these are typically treated differently. They're considered money, or representatives of money. Selling them on a deferred basis with a markup would directly resemble interest, or riba.
Right, the core prohibition.
Exactly. Additionally, the source strictly prohibits issuing tradable Islamic bonds, known as sukuk, for Murabahah debts.
Okay.
Or even renewing a Murabahah on the exact same commodity. It's all about ensuring genuine sales of real assets, not just financial engineering, to create debt.
Okay, this is fascinating. Let's get back to Alex and his promise. You mentioned his initial request doesn't usually include a promise, but what if he does make one? Here's where it gets really interesting for Alex, I think. While a promise in, everyday life feels very binding, in Murabahah, the client's promise to purchase isn't always the strict ironclad requirement. Can you unpack that nuance for us?
Certainly, it's a common point of confusion. The promise itself or its specific framework can actually be dispensed with.
Really?
Yeah, they aren't inherent requirements for a valid Murabahah contract to eventually be formed. It's also permissible to include an option condition in the promise, giving Alex some flexibility or even to modify its terms later on, by mutual agreement, of course.
So let's play this out. Alex makes a promise to buy the car. The bank goes and buys it based on that promise, but then Alex changes his mind before the final Murabahah contract is signed. What happens then? Can the bank charge him for backing out?
Okay, this is a crucial distinction from conventional finance and honestly a real aha moment for many people when they first learn about Murabahah.
Okay.
If Alex backs out after making a promise, compensation for the institution is strictly limited to actual damages.
Actual damages, what does that mean in practice?
It's defined very clearly. The difference between the car's cost to the institution, what they paid Speedy Motors, and its sale price to another buyer.
Another buyer, not back to Speedy Motors.
No, to a new third-party buyer.
Yeah.
And critically, this compensation does not include lost opportunities.
Lost opportunities like the profit the bank expected.
Exactly. The bank cannot charge Alex for the profit they would have made if he had gone through with the purchase. It fundamentally reinforces Murabahah's ethical stance.
Wow.
The institution can only recover actual proven out-of-pocket losses, not speculate on potential profit they missed out on.
That's a massive difference from, say, breaking a conventional contract where you might sue for expected profits.
Huge difference. And related to this, what if something happens to the car before Alex even gets it, like during shipping or while it's sitting at the bank storage? Who's on the hook for that damage?
Good question.
The institution cannot charge Alex for damages that occur to the car during shipping or storage, before the institution's ownership and possession are fully established and liability shifts.
So the risk is truly with the bank.
Absolutely.
Yeah.
It highlights that the risk is truly with the bank until that point of possession transfer. Now, to help mitigate potential losses, if a client like Alex does renege on a promise, the institution can hold a security deposit. It's known as Hamish al-Jadiyah.
Hamish al-Jadiyah. Okay. And what's the purpose of that? Is it just like any other security deposit?
Not quite. Its purpose is specifically tied to what we just discussed. It's there to cover those actual damages if Alex backs out of his promise.
So it's not a penalty?
No, it's not a penalty. It's more like a good faith deposit. And a key rule is that this security deposit must be returned in full if the promise is fulfilled and the Murabahah contract actually goes through.
Okay.
It's also permissible, interestingly, to agree upfront to deduct this security deposit from the car's final price when the Murabahah contract is concluded. So it's not a penalty fee, but a practical mechanism designed purely for actual loss recovery if the client walks away from their promise.
That leads us perfectly into perhaps the most fundamental principle of Murabahah, ownership and possession. This really feels like the heart of what makes it distinct from a traditional loan, doesn't it?
It absolutely is. If we connect this to the bigger picture, what truly makes a Murabahah transaction genuinely distinct from an interest-based loan boils down to this ownership and possession.
Yeah.
The institution must truly own and possess the asset before selling it. This is paramount.
Why paramount?
Because it means they genuinely bear the risk associated with that asset. They're not just financing it on paper.
Okay.
The institution is strictly forbidden from selling the car to Alex via Murabahah before it has taken actual ownership and possession. And think about this. If the institution's initial purchase of the car was somehow void, maybe it turned out to be stolen property, for example,
Oh, dear.
then the subsequent Murabahah contract with Alex is also invalid. The whole chain relies on that initial valid purchase and ownership by the bank.
So how does the bank actually take possession of Alex's car? Does someone from the bank literally have to drive it off the lot? Is it always physical?
Not necessarily always physical, no, but possession, or kabbed as it's termed in Arabic,
Hob.
must be verified. It has to be real. Now, it can be actual physical possession, like, yes, a bank representative physically picking up the car, or, importantly, it can be constructive possession.
Constructive. What does that mean? Legal possession.
Yeah, essentially legal or symbolic possession. Think of situations where physical handover isn't practical immediately. The primary purpose, the reason why possession is required, whether it's actual or constructive, is for the institution to bear the risk of the commodity's loss or destruction during that period.
Ah, the risk-bearing element again.
Exactly. So the exact point of separation, the moment where the car's liability shifts from the dealership to the bank, must be clearly defined and verifiable.
Can you give us some practical examples of how that works, beyond just physically picking up a car?
Of course. So for real estate, actual possession is generally achieved by vacating the property and enabling the buyer, the bank in this case, to dispose of it freely. Keys handed over, tenants out, that sort of thing.
Okay.
For movable goods like our car, it's usually according to their nature. Physical handover is common. But constructive possession is really useful, say, for purchases from foreign markets.
How so?
Well, simply receiving the official shipping documents, like a bill of lading, often counts as constructive possession because the risk typically transfers at that point according to international trade norms.
Right, Incoterms and such.
Precisely. Or for goods already stored in warehouses, receiving specific storage certificates or warrants that clearly indicate possession and control suffices. Ultimately, the responsibility for guaranteeing the item being sold transfers to the institution upon its verified possession, actual or constructive. Meaning, if something happens to the car before the bank formally possesses it, it's the dealership's problem, not the bank's, and certainly not Alex's yet.
Okay, that's crystal clear. Now, what if the bank needs Alex himself to act on its behalf in acquiring that red sedan from Speedy Motors? Maybe it's faster or more convenient. Are there specific rules of engagement when the client acts as an agent for the institution?
There absolutely are. And this is an area where institutions have to be careful. First off, appointing the client, Alex, as an agent is only permissible in cases of urgent need or significant practical necessity.
So it's not the default option?
Definitely not the preferred method, but it's allowed when circumstances genuinely demand it. Now, crucially, Alex, acting as an agent for the bank, does not sell the car to himself.
Right, that would be circular.
Exactly.
Yeah.
Instead, the institution, the bank, sells the car to Alex after the institution has legally taken ownership of the asset, even if Alex facilitated the purchase as agent. It's still a two-step process.
So the bank still effectively buys it from the dealership first, even if Alex is doing the legwork.
Precisely. And to maintain that clear distinction and avoid any ambiguity, the institution must directly pay the purchase price to the original seller, Speedy Motors, itself.
Not just give the money to Alex to pay.
They should not deposit the funds into Alex's personal account for him to pay whenever that's practically avoidable. Direct payment is preferred. It's also essential to obtain proper documentation, invoices, receipts to confirm the authenticity of that initial purchase and sale from Speedy Motors to the bank.
Okay.
And, interestingly, to really distinguish between the institution's liability phase and Alex's eventual ownership phase, the guidelines suggest there should ideally be a period of time, however short, between the execution of the agency agreement, where Alex acts for the bank, and the conclusion of the final Murabahah contract, where the bank sells to Alex.
Like a small buffer.
Exactly. A buffer to visually and legally reinforce the two distinct transactions.
That's a lot of meticulous detail for documentation and timing. What about whose name actually goes on the purchase documents from Speedy Motors?
Good question. Generally, the purchase documents should be in the institution's name, reflecting their role as the buyer.
Makes sense.
However, they can be in Alex's name if he is explicitly acting as a documented agent for the institution. The agency agreement justifies his name appearing.
Okay.
And here's a quirky detail. The agency agreement itself can be undeclared or undisclosed to the third party, like Speedy Motors.
Really? The dealership doesn't need to know Alex is acting for the bank?
Not necessarily, as long as the legal relationship and the flow of ownership between Alex as agent and the bank as principal, and then from the bank to Alex as buyer, are clear and properly documented internally.
Fascinating. Okay, so sticking with this theme of the bank owning the asset for a period and bearing the risk before the final sale to Alex. What about insurance? If the bank owns the car, who's responsible for insuring it during that interim period?
That's a very practical and important question, especially for higher value assets. Our source clarifies that insurance on the commodity of the car before its sale to the client, Alex, is entirely the institution's responsibility.
So the bank pays the premium?
Yes, it's at their expense. And logically, the right to any compensation from this insurance also belongs solely to the institution.
Because they hold the risk at that point.
Exactly. They're the ones holding the risk, so they get the insurance payout if something happens.
And can the bank then pass that insurance cost along to Alex somehow?
Yes, that's permissible. The institution may add the insurance cost to the total cost of the sold commodity.
So it gets factored into the Murabahah price?
Correct. It becomes part of the cost base upon which the bank calculates its profit margin for the Murabahah sale to Alex. This is allowed because it's a direct, actual cost incurred in acquiring and holding the asset before the sale.
Okay.
Now, there's a key requirement here, though. Whenever possible, the insurance obtained by the institution should be takaful.
Takaful, right? You mentioned that principle earlier. Can you quickly remind us what that means in this insurance context?
Sure. Takaful is essentially Islamic cooperative insurance. It operates on a principle of mutual aid and shared responsibility.
How does that work?
Participants contribute to a common fund, and any losses incurred by members are paid out from that shared fund. It's structured to avoid elements like interest, riba, and excessive uncertainty, gharar, found in conventional insurance.
So it's about risk sharing, not risk transfer for profit.
Precisely. It aligns perfectly with the overall ethical principles of Islamic finance that we've been discussing. And just for procedural ease, the source notes it is permissible for the institution to delegate the actual insurance procedures to another party, like an agent or broker, as long as the policy is takaful where available.
Okay, great. Let's move towards the finish line then. We get to the moment of truth. Concluding the actual Murabahah contract with Alex for the car.
Right.
What happens if, after all this preparation, the car isn't quite right, or maybe Alex just gets cold feet right at the end?
Okay, important point first. Even after the institution successfully takes ownership and possession of the car, the Murabahah contract cannot be considered automatically concluded.
It still needs Alex's explicit agreement.
Yes, an explicit offer and acceptance for the Murabahah sale itself are always required. The institution cannot compel Alex to receive the car and pay the agreed Murabahah price if, at that final stage, he refuses to conclude the contract.
Wow, so the client really holds the power right until the very end.
It highlights the client's ultimate freedom of choice, yes.
Yeah.
Right up until the final handshake, so to speak.
That's a significant protection for the client. Okay, so what if Alex does agree, signs the contract, takes the car, and then discovers a defect, a hidden problem, a UUB, I think is the term.
Yes, UUB for defects. This is where guarantees come into play. The general rule is that the institution, as the seller in the Murabahah contract, guarantees against hidden old defects in the car.
Hidden and old, meaning things that were there before the sale.
Exactly. Defects that existed before the sale that Alex couldn't reasonably have known about, unless the institution explicitly states an exemption from such guarantees in the contract.
Can they just exempt themselves from everything?
Well, the institution can be exempt from responsibility for all or some defects, but, and this is crucial, they cannot exempt themselves from damage or deficiency that occurred before they took possession or while it was under their risk. That initial risk is always theirs.
Okay.
The source also notes that a sale of absolution is permissible.
Sale of absolution sounds dramatic.
It just means a sale where the seller explicitly disclaims responsibility for all defects, essentially selling the item as is.
So the bank can say, we're selling this car as is, defects and all.
Essentially, yes, provided that's clearly communicated and agreed upon up front, and again, provided no damage occurred while it was still under their possession and risk.
Okay. And what's the practical way to handle it if Alex does find a defect after the sale?
In practice, the source suggests it's actually preferred for the institution to authorize the client, Alex, to deal with it directly.
How?
Either authorize him to return the defective car based on the defect, or perhaps more commonly, authorize him to directly pursue compensation or repair from the original seller, Speedy Motors, using the bank's rights as the initial purchaser. It just streamlines the process for everyone.
Right, avoids the bank having to mediate everything. Okay, one more scenario here. What if Alex signs the contract, agrees to the price, but then for whatever reason just refuses to physically take delivery of the car?
That can happen. In such a case, it is permissible to have stipulated in the original Murabahah contract that the contract can be canceled if the client refuses delivery without a valid reason. Or, alternatively, the contract could stipulate that the institution has the right to sell the car on Alex's behalf.
So the bank sells it to someone else?
Yes, acting sort of like an agent for Alex in this specific situation. The institution would then collect its dues, the Murabahah price Alex owes, from the proceeds of that sale.
And if the sale price isn't enough to cover what Alex owes...
Then Alex still owes the remaining balance. The bank isn't left completely in the lurch just because he refused delivery after signing.
Okay, that covers the final stages of the sale.
Yeah.
Let's talk briefly about the long-term commitment now, the repayments. What happens if Alex faces delays in making his installment payments for the car, or maybe needs to adjust his repayment plan down the line? The principles here must be very specific to Shari'ah compliance, right? To avoid interest.
They are indeed, and this is another area where Murabahah and Islamic finance generally truly differentiates itself from conventional lending.
How so?
Well, firstly, it is permissible to stipulate in the contract that all outstanding installments become immediately due if the client delays payment beyond a certain point. That's a standard acceleration clause found in many types of contracts.
Okay, that sounds familiar.
But here's the unique part, the Sharia-compliant alternative to late fees or penalty interest. It is permissible to include a clause stipulating that in case of delay, the client is obligated to donate a specific amount to charity.
Donate to charity. If he's late on his car payment, how exactly does that work?
Exactly. It sounds unusual at first, but the mechanism is quite clever. This donation amount must be overseen by the institution's Shari'ah Supervisory Board. And critically, the institution itself cannot benefit from this donation in any way. It has to go to a genuine charitable cause.
So it's not a disguised fee for the bank?
Not at all. It acts purely as a deterrent for delaying payment, encouraging timeliness through an ethical mechanism rather than imposing interest, which would be prohibited riba.
That's a really interesting approach. What about the opposite scenario? If Alex wants to pay off his Murabahah early, can he get a discount like you might with some conventional loans?
Yes, that's possible. It's known by the Arabic term dawatajal, meaning essentially a discount given for early payment. This is permissible, but only if it was not pre-stipulated as a right in the original Murabahah contract.
Why that condition?
Because if it were a pre-agreed contractual right, it can be seen as structuring the deal in a way that implicitly involves time value of money calculations akin to interest. Instead, it should be offered voluntarily by the institution at the time of early settlement, considered an act of goodwill or generosity.
Got it. Voluntary discount, not a contractual right.
Precisely. And similarly, it's permissible to agree at the time of payment that the settlement be made in another currency. Maybe Alex wants to pay the remaining dirhams in dollars. That's okay. Provided the currency exchange happens on the spot, nothing remains outstanding from the exchange itself, and crucially, this option was not explicitly stated as a condition in the original contract. It has to be a separate agreement made at the time of settlement.
Okay. And what's the absolute ultimate red line, the thing you absolutely cannot do when managing Murabahah debt?
The absolute crucial prohibition, the big one, is rescheduling the debt for a defaulting client by increasing the total amount owed.
So adding extra charges because they're late and need more time.
Exactly. Charging more for giving more time is strictly prohibited because that would directly resemble interest, riba, which is the very thing Murabahah is meticulously structured to avoid. The profit is fixed at the time of the sale. It cannot increase simply due to delayed payment.
That seems to be the consistent theme, avoiding anything that looks and smells like interest.
That's the core principle running through all these rules.
So wrapping this up, what does this all mean for you, our listener? You've just gained, hopefully, a pretty comprehensive understanding of Murabahah. We've gone from Alex's initial request for that car through the absolute importance of genuine ownership and possession by the bank to the nuanced rules around using Alex as an agent, handling defects, And finally, managing the debt ethically. It's really a powerful testament, isn't it, to how Islamic finance meticulously crafts alternatives to conventional interest-based systems. The focus is clearly on ethical principles, tangible assets, and genuine risk sharing.
Absolutely. It's far more intricate and principled than just a simple markup sale, which is sometimes how it's misunderstood.
Certainly.
This deep dive really highlights that Murabahah is a structured process. It has incredibly clear checks and balances built in, all aimed at ensuring fairness and transparency every step of the way. Knowing these specific rules about possession, about agency, about compensation for reneging, about debt management, helps you really appreciate the intricate design behind these Sharia-compliant financial products.
Yeah.
And maybe here's something to consider. How might these principles we've discussed, particularly genuine ownership by the financier and their explicit responsibility for the asset before sale, how might those influence your perspective when you look at other financial agreements you encounter? Does it make you think differently about how risk and reward are allocated, maybe sometimes hidden, in the broader financial world?
That is a fascinating thought to mull over. Comparing the transparency here with other structures. Until next time, keep digging deeper.